Hey to all our viewers, my name is Salem Simon. My wife and I, Danielle, work with SJ Fowler Real Estate. I have with us with our conversation with experts, Jen Duffy here. How you doing, Jen?
Hey, I'm good. How are you?
Jen is with a senior loan mortgage originator with Cross Country Mortgage. Tell us a little bit about yourself, the mortgage company you work with, and things that you're doing currently.
I am a more recent transplant to the Arizona area. I've been here about 2.5 years. I started with a different company in mortgages about a year ago and just switched over to Cross Country. I'm here because of the opportunities to help more people. Part of what I do here is I'm able to work in multiple states, which is a fantastic opportunity. And I have the opportunity to both work in conventional as well as jumbo situations. So I have more opportunity to work with all sorts of income levels. And I'm also doing a lot of refinances.
That's awesome.
I also get to work with a lot of vets here, which is one of my special little close to my heart situations. Yeah, I enjoy that a lot.
Tell us a little bit more about the veterans and stuff and why that's close to your heart.
Well, both my grandfather, my mom's dad, and my dad served in the military. So to me, that's just a very important thing. You know, my family, and actually both of my brother-in-laws are military. So it's just really nice to me to be able to give back to that community because they give so much to us.
That's awesome. And just knowing that Arizona is a place where several military bases, this is a great hotspot for you. I know I'm from Ohio, so we have a few bases there. My dad and my stepfather were in the Army. They were both E7. So I know I have a lot of friends that are, and fraternity brothers that are a part of the United Forces, Armed Forces. So the other part, again, we've always had connection, and Jen, you've been awesome in sending referrals, and we send people back to you to kind of get this going. Just so people know, like, our whole goal with this conversation with experts is to put the ball back in the experts' court. Yes, we deal with realty and real estate and getting people homes and investment properties and stuff, but they need the financing first to be able to get that, and then be able to prove that in order for deals to close. Now, here in our market in Arizona, we know that things are like hotcakes, right? As soon as something,
oh my gosh, yeah.
As soon as something comes up, we have to be ready to go. And it's more advantageous now as a realtor, even more so, to have our clients ready to be able to make an offer that's a legitimate offer and then feel comfortable. And then there's no like downtime in terms of getting those offers and what the lender can do right in place. So I thought it would be great for us to start off this conversation with experts, because we know a lot of people are renting right now. The rental rates are sky high, but also in our particular case in Arizona, our inventory is low, but we want to be able to help people be ready when the time comes to purchase, be able to have the things they need. So I'm just going to kick it off with you. We'll take a little bit. What's some frequently asked questions, or what's the number one that you can think of right now that comes right off the top of your mind when people are looking to, hey, I need a pre-qualification, I need to be pre-approved. What do I need to do? Like, what questions are they asking?
Most people come to me with, well, how much do I qualify for? Or, well, what's the interest rate today? So those two questions can only be answered with me being able to see your credit report. That's key to several things here. When I'm able to look at your credit report, I don't just see your score, but I see your repayment history. That is a big factor when your loan gets to that underwriting stage.
Okay.
So I'm that first step in the whole loan process. But what I feel is super important in my first step, my job, is to make sure that by the time what I've compiled gets to that last step, that all that underwriter has to do is look at it and say, you're good to go. I want my loans to get through underwriting. I don't want them to come back and say, oh, this isn't going to work. Oh, this is denied. So I don't want any surprises from the start.
Okay.
I personally go through some extra steps at the beginning just to save everybody time at the end.
Okay.
I feel that's super important.
I think that's awesome. We're not going to take any assumptions that people know all the terms that we're talking about. In terms of underwriting, what would that mean to me as the home buyer or the person that's trying to get a mortgage? What is what's the underwriter? What do they do, and why are they important? Why?
So the underwriter, what they do is they look at my whole loan package, everything that I've compiled, which will include many documents like your taxes and your banking statements, your W-2s, your pay stubs, and you may not be a traditional income earner. Maybe you're self-employed. Maybe you're retired. So I will get those documents too, your 1099s, your P&Ls for the year to date. I'll look at things like maybe you're on disability. I can use that income. I can use your Social Security benefit income. But we use that income, we get all of those items together, and we develop your package that we present to the underwriter. And the underwriter's job is to determine whether or not this file is creditworthy, and if this is a strong file for what we're doing. We're borrowing someone else's money, right? We're saying, hey, can I borrow money from you so that I can live in this place? Right. And the underwriter's job is to make sure that they protect the person lending the money. Right? So they've got to make sure that this file is going to hold water through the whole 30 years or 15 years or however long your loan term is. They want to make sure it's a viable file and that it's going to go to term.
Okay, that makes perfect sense. And speaking, the underwriter, they help make sure that this loan is okay for this amount and that the documents prove that this person can make these particular payments on a consistent basis.
And they're kind of that last line of defense. So after it goes through all the other processes, the underwriter has that last go over. It's kind of like that last set of eyes, just making sure every I is dotted and every T is crossed. And they give that last either approval or denial.
Okay. I also want to make sure that people know that you can leave comments below when we post this, so that if you have certain comments about things that we've stated in here, that you can actually be able to leave them with them, and we'll be able to answer those questions on our next conversation with experts. As we just move forward, pushing past that, explaining the underwriting, we've talked about, people want to know how much can I afford or what do I qualify? Can you explain maybe like credit scores? So you're going to see these particular credit score, these ranges. I think things work better in threes, right? I know good, better, best, or I know.
Right.
Like tell us what those ranges are if you have something like that, if that's something that you even look at.
So every lender has different scoring requirements. They're called overlays. They're things that to protect them as well. And then different loan programs will have different credit score requirements. I never like to box somebody in like a good, bad, or good, better, best. Yes, you work hard to get good credit, and it's a job. It's hard work. To have an 800 credit score, to have a high 7 credit score, it's a job. It's hard work, and it's a lot of being on top of paying things on time and making that sacrifice, because it's not easy to do. Not to say that someone who doesn't have a score in the 7s or 8s isn't doing work as well. Life circumstances happen. So I never like to, assume anybody's situation. But what I like to try and do is work within what your situation presents to me at the time. And so when I see what I'm working with, then I'm able to determine which program is going to work best for you. The nice thing about what we have options. You may not have great credit right now, but you may really need to get out of the place you're in and into something else, and you're just up to here with renting and you really want to buy, and you're just like, I just got to buy now. That's fine. We can get you into something. Most cases, depending of course on your credit score, depending on your ability to come up with some sort of a down payment, or get approved to work with a down payment assistance program, we're able to get you, into a loan. But it's not always a percentage rate, an interest rate that people are interested in. They get a little, oh, that's high. I've seen Quicken that says, I've seen this other place that says it's, X percentage. Why is my rate so high? Well, your credit score is a direct correlation to what your interest rate is going to be. But that's okay. You pay your mortgage on time. You have your mortgage seasoned. Depending on which program you're in, you have a certain amount of months that you have to make payments. I usually just tell people, just to play it safe, come month 7, we can look at refinancing and you can get into a lower interest rate. Most times, the only out-of-pocket expense for refinancing will be your appraisal, and we can go from there. And with the way our market is here right now, especially in Arizona, it's a good market across the country. Truly, we've got things are going nicely, really, in all the states I'm working in. Everybody's seeing a nice increase in home value, but here in Arizona, it's like really good. So I've worked with people who purchased homes at the beginning of the year and they want to refinance because they've got a ton of built-in equity just from that,
for sure.
That little instant boost in their home equity just from this market.
And I'm pretty sure we'll talk to some more experts in the appraisal part are coming forward, because I have some of those people. But the biggest thing that I took away that I'm learning, a lot of times the appraisals are going backwards and the market is already pushing forward, meaning like they're appraising homes that have already previously been on the market, when because of the market's push and there being not a lot of inventory, the people are like, I just want to get in a home, so I'm going to pay what I need to pay to get out of this current one to be where that speaks to what you're saying.
Volumes, right?
I know, and I'm asking this question just to maybe someone else out there. Like, do you have issues sometimes where you're trying to help a consumer see, okay, it may not be interest rate so much you should be worried about, is actually what you're paying. Like what you're actually going to pay, right? Getting them to kind of see.
Yes, and in this type of a market, so it's a tightrope that I have to walk as a loan officer. I can't steer someone in a direction, and I have to just give them the facts, pretty much. But it is tough to see somebody who just really wants to get into a place and they don't care if they've got to come down or come up with extra money down just to get into it, because maybe their appraisal didn't quite match what they wanted to offer just to win that bid. And I'm sure you've seen that too.
I've seen it
as an agent. A lot.
It's stress on the agent sometimes too, knowing on the sellers, knowing like, okay, I know this is what they're offering for this home. I hope that it appraises for that.
Yeah.
That assists because the buyer has to be willing to come up with the difference, and that's fine. But if they're not, then sometimes you may feel like there's X amount of days that we're behind because this deal actually didn't go through. And, you know, that's just kind of educating on both sides.
Yeah. I've also had situations where I've had borrowers who have put in offers on homes and they've lost out to someone who has bid higher, and the appraisal did not come back to match that offer. And those potential buyers did not want to come up with the difference. So then the agent came back to my buyer.
Mm-hmm.
So that worked out pretty nicely. Yeah.
And that goes back to our agent side, knowing what these home values are worth and what's kind of what's a push in the market and what's like just, okay, this is a little bit overpriced.
Yeah.
Just knowing that.
Yeah. You gotta walk away. You gotta know when to walk away. Yeah.
Know when to hold them, know when to fold them, right?
Yes.
Yes. Just wanted so another thing that I want to talk about, explain to our viewers what's the difference between like a pre-qualified offer and like pre-approved.
Generally with a pre-qualification, we're not getting as much data. Okay. A pre-qualification just kind of goes over the basic information. You'll get down basic data points, like, of course, social security, date of birth, and you get information on how much money somebody makes. You maybe will even go as far as to get current pay stubs and maybe even banking statements. When you get a pre-approval, you are doing the whole 9 yards. You are getting 2 years of tax statements. You're getting, 2 months of banking statements, 30 days of pay stubs. You're getting everything that you need to send the loan off to processing up front. You want to make sure all of your documents are in place. I personally, especially in this Arizona market, and I just feel this is a good practice to have for people. A pre-approval is a better way to go.
Okay.
No secrets, no surprises come out on the other side when you do a pre-approval up front. That way you've got literally, as an originator, I've got all of my ducks in a row. For you, as the person I'm working with as the agent, I want to give you, even if this is your client that you've brought over to me and say, hey, Jen, help me out here. Yeah. I want to give you back that information in full. Yeah. I don't want to, pardon my French, I don't want to half-ass it. Yeah. Okay. I want to make sure that both you and the buyer are fully prepared when you go in to make an offer, so that you don't have to go back with your tail between your legs later and say, oh, I'm sorry, because that has happened to me and I won't ever let that happen again.
Yeah. And then as an agent, even on the selling side, I'm going to contact a loan originator or like you, Jen, to make sure that the offer that I'm accepting is a good offer, and that you
exactly
people before, and that all the ins and outs, what down
exactly
they can afford, so that I can know this is a solid offer, so that I can tell this to my seller that, hey, this is something that is pretty solid. If you're comfortable, we can go with this, just to let the audience know, like from the seller's side as the agent. And then
yeah, exactly. And I never even thought of it like that, but yeah, exactly. It's good for both sides. It's important to have that, to be thorough.
Thorough is a great offer. We want to make sure too that we're giving the information that we're going to be able to run with, that like, this is good. This is the offer that you have. You can make this happen. We're solid. And then from the agent standpoint, me and being on the buyer's agent now flipping sides, I want to make sure, okay, well, Jen is showing me that they can pay X amount of dollars, whether it's 300, whether it's 400,000, whether it's 150,000. Okay, I may have to give some cushion so that way, if we are negotiating back and forth, I don't leave the clients or our buyers hamstrung, for lack of a better term, of not being able to another, counter offer to certain things. So it's awesome to like kind of know where that pre-approval works. The other part I was going to say is, how long is this pre-approval good for when they get one?
Well, your credit, the pre-approval is based off of your credit score, your current credit report. Okay. And you really have to do that within 4 months period of time. You've got to, so, and your pre-approval, yeah, you could take 4 months to do all of your X, Y, and Z's. However, you then have to kind of start from scratch with your whole file, because you've used your entire time period.
Yeah.
Right. So that's just something to think about too. However, not that that's bad. Sometimes it takes time. I have people that I had been working with since February. They still have not found a house that they like. Okay. But they've pulled all of their documents together. They've got everything ready. So they have to update, their pay stubs. They'll have to update their banking statements. But other than that, everything else is good to go. So it's as simple as adding a few fresh documents in and, revitalizing their credit scores, and they're good to go. So for everybody, getting that pre-approval makes things a lot simpler.
Okay. All right. Let's take another aspect now. Sometimes that we have to explain, or you have to explain as the loan originator, what you're looking at the people's document. And it's not a big word, but it affects us all. Debt to income ratio, right? Debt to income ratio is like, explain that term to us, because sometimes we don't even know what people are looking for. All we know is what comes out of our pocket. And then now we're trying to help. Okay, well, where do I need to be at? And so can you answer that for us?
Yes. Debt to income ratio can be a little tricky. Yeah. Debt to income ratio, what I do is I look at two sides of debt to income ratio. I look at your debt to the housing income first and make sure that that's at a certain number. And then I look at your debt to income with the housing plus your other debts, your car loan, your credit cards, Macy's, Nordstrom, Bloomingdale's, right? All of those guys, right? So it's twofold. There are two sides to that debt to income, and it's the housing, and then it's the total debt to income, that whole ratio. There are guidelines as to where you need to keep those numbers.
And then for some loans, it's, what can you explain the different percentages? And we would go into grave detail, but just so we can get like a percentage for this style normally, and this and the like FHA, and then conventional, what's the different ones?
So with a conventional, we were always taught with a conventional loan, keep it around 36. With FHA, keep it around 43. There's wiggle room in there. I feel like maybe I shouldn't say that, because then people try and push their limits. Yeah. That's not what the wiggle room is for. It's not for you to go get another credit card now. It's to allow for things like, unexpected things happen. Yeah. Your hot water heater explodes and you have to go to Home Depot and get a new one. Yeah. That kind of stuff happens. So your car breaks down on the side of the 51 and you got to go replace it, or get 4 new tires, or whatever it may be. So, there are things that come up, and we do have a little play there in those numbers. but we do like to try and keep it around those numbers. And the reason being is just simply because then you are a stronger candidate for approval. So the closer to these numbers that you stay, the stronger your opportunity is to be approved.
Okay. And I guess if people may know or they may get into this, I think this is a good question that leads towards that debt to income ratio, but also goes on the credit side, and depending on what particular loan product that you use. Can you talk about like private mortgage insurance, or like stuff that may be new for some people to see on a loan, but know, like, help them understand what it is and what's going on and who's it protect and what's it for?
Sure. Mortgage insurance is something that has been developed to protect the lender from default. Mm-hmm. And so when your value, the amount of money that you have invested in the house is less than 20% of the value of the home, you pay mortgage insurance. So in addition to your monthly payment. Now, if you have not even if you have, your mortgage insurance is wrapped up into your monthly mortgage payment. So it goes in there with your taxes, your insurance, the principal and interest. It's all wrapped up into one.
Yeah, we call it a payment.
Okay. Right. So the mortgage insurance is for conventional loan, it's mortgage insurance. With most conventional loans, once you hit that 78% loan to value, the lender, and you have to read your paperwork, but most lenders will take out your mortgage insurance. Sometimes you have to call and let your mortgage company know, hey, I've hit that mark, I want this out.
Yeah.
With an FHA loan, the government loan, FHA works differently. They have different ratios, and that does not come off at that when you've hit that 20/80 ratio, you keep that for the life of the loan. Now, if you're looking at a VA loan, you don't pay that monthly payment, you pay a funding fee instead. So you don't have to worry about paying monthly insurance and whether or not that's coming off. They lump the sum in, they spread it out on your 30 payments or 30 years of payments, and, have at it.
Yeah, and again, leave your comments below, because I'm pretty sure between FHA, conventional, and especially VA loans, there are going to be some questions and comments about, okay, what do I need to know? How do I protect myself? And then how do I either keep from paying this, or how do I know if I have to pay this, when is it time? Right. So you can leave those comments, right. You can be able to answer those specifically, because we're talking in general, these loan products that Jen and many other lenders have can get pretty specific, and we're trying to make sure that we stay on the surface. Due to this pandemic, I had a few questions, and we'll probably, if I'm an entrepreneur, or I decided during this pandemic, hey, I'm gonna go into, business for myself. I still want a house, or I'm trying to purchase. What do I need to do? Like, how do I make sure?
So for most self-employed borrowers, we do need to see 2 years of reported income, taxed income. So that's very important. Now, if you are staying, and these guidelines are probably going to change from lender to lender in terms of what they feel comfortable accepting or not. But if you have been, let's say this, I'm from the DC area, a lot of government contractors, yeah. All right? If you worked for the government And for some reason, even though the government didn't shut down,
Yes.
we're pretending, guys. You know, lost your job and decided that you were going to be an independent contractor for the government now. You're still working in the same line of work. That might be something we can work with.
Mm-hmm.
Again, most lenders have what's called a scenarios desk, where we're able to bring these situations to their attention. They can bring them to an underwriter. And, you know, the more information we have, the more data we can collect, the better a case we can bring so that we can get a better answer. And not a better answer that's, oh yes, in favor of, or what our borrower wants to hear, but a better answer that's truthful and going to help us to decide if this is a good program or a good fit or a good time to purchase. So that's an important distinction right there too.
And I think it's important too for us to have those conversations, for people to feel comfortable having conversations with you and someone like you, to know, like, I come from the era of when the grandparents, don't let people know what's going on in this house, or don't tell people.
Yep, me too. Yep.
But sometimes in sharing this information, it helps you be able to better help them get a product that's going to be beneficial for them, and they don't have to hear it third hand. And it's like, oh man, I could have did this 6 months ago. I could have did this a year ago.
Right.
Why didn't I do it before I jumped into the business? That you have those particular things, and that's what we're hoping to bring about with the conversation with experts, is that you don't have to know everything, but you do have to know who to ask the right questions to, and you do have to not lean on your understanding, or like we talked about off camera, is like, people will just not do. Like, hey, I know it is bad, so I'm just not even going to look at it. I don't even.
Right. Like the.
But it doesn't make the situation better, right?
It doesn't. And you know, what I tell people who come to me and they, you know, and they want to buy a house, and they look on Credit Karma and they're like, oh, I've got a credit score. It's 600. And then I pull their credit and it's not that high, because I'm looking at a different type of credit scoring, which we can talk about at another time as well. But they get so embarrassed and they're so upset. And, you know, I tell them, this is probably the best thing you could have done, because now you're seeing what I see. And if you really want to buy a home, now you know what your mortgage person is looking at. And now you know what you need to fix so that you can come back and actually buy a house.
Right.
I have had many people who came to me months ago who were not qualified for a home, and now they're back because they did the things I told them to, they fixed the things I told them to fix. They did the things I told them to do. And now they are in great ranges and able to make a purchase, and not just make a purchase, but to really get good rates on their loan. And that's what's also important for them. So that worked out great. But they would have never known if they either hadn't started the process, or if once they got there and saw where they were just like, it's too much, I don't want to do it. Because it's a lot of work. But remember what I said earlier, good credit, it's a job.
Yeah.
It's a lot of work. So, you know, it's not just a lot of work because maybe your credit's not so good. Keeping good credit is work.
Yeah, no, and our goal here is to be able to educate all our potential buyers and sellers of what the buyers are thinking, but all of our potential buyers of what they need to do to be prepared. Because I think the fear of rejection is what's overriding us. And somebody once told me fear is false evidence appearing real. And in that,
I like that.
So in that, it may be true that you had some mishaps, or straight out of college, they give you credit cards, or you go through divorce, or you know, you got child support, you got to another state, or you lost a job, or you changed careers, you got student loans.
Yeah.
All of those things.
Yeah. You have a health issue, you know, anything. Yep.
And
things happen in life.
Yes. We're here to say that things happen in life. We can help get you onto a place where you can have a home, because at the end of the day, the purchase and having your own home and that bit of property is going to be something that you can pass along for generations, or the start of that helps you pass on wealth in your family. So that's what this thing is about.
Yes.
Not who can sell what, who can do what. It's helping families create generational wealth. And that's we're in the business of helping people see that. And no matter how small they start, right?
Right. Just, you know, a little 2-bedroom condo, but that's all yours. All yours. Nobody else's.
Right.
You make that your home, and it's yours.
It's so many different things. Look, that's a whole nother conversation with experts, starting small and being able to multiply off of that.
Yes.
Yeah, I know our time is running short. I wanted to razz you about how the Browns beat the Eagles and what Carson Wentz. But
sorry, I'm having a hard time hearing you. We must have a bad connection. Listen, I started this family fantasy football thing, and I have found that I don't even follow my own team anymore. I'm like, what's this guy doing? What's that guy doing? What is football anymore? It's just each individual player. And every Saturday I'm checking my phone. Like,
oh my God.
Thanksgiving morning, I'm trying to make sides and fix my lineup. Like,
But yes, of course, the world is turned upside down. The Browns are 8-3, and the Eagles are probably
you know,
3 wins.
I think they have 4. So
slow down.
4. Somebody said at the beginning of the season, the Browns are going to win the Super Bowl this year. Might happen. You never know.
Oh
never know.
Maybe
you would die.
Maybe Baker will stop throwing interceptions. Who knows? As long as they hand the ball off to Chubb, we'll be okay. I would like to thank you, my friend, for this time. We will talk again.
Thank you.
Feel free for everyone to leave their comments below. Jen is again with Cross Country Mortgage. She's in multiple states, Ohio, for those that follow us that are from Ohio, Arizona. Of course, we talked about Virginia, Maryland, and there's a few other states that she's opening up for. So she'll be able to help you or assist you, and leave a comment and we'll be able to reach out to you. Again, in this conversation with experts, we just want to be able to help everyone get closer to what they want. Any last words, Jim, before I go?
Nope, just great talking to you. Thanks for having me. It was a lot of fun. Thank you.
Oh, pleasure is all mine. Again, my wife Danielle is the director behind all these things, and she just puts my face on the camera so that she can go take care of everything else and hold my world together. So I appreciate you guys for this time.
She really does. She's the glue, man. She's the glue that keeps us all going.
Yep, she's got us. All right, thank you for your time. We will see you on our other conversation with experts. Thanks, Jen.
Thank you. Bye.